Welcome back. Earlier today, it was reported U.S. wholesale inventories fell more than expected in October, reported by the Commerce Department. Now, the real question we want to ask is that when inventories go down, it means either that we're selling a lot more or we're producing a lot less. This is an older article a couple of years ago, but they made an interesting point. They said when business inventories fall, it could mean a couple things. Either stuff's flying off the shelves because sales are up and the economy's hot, or it could mean that spending is slowing down and production is slowing down. This is said by economist Ben Herzon. So when we look at each of the subsequent charts, let's ask ourselves, when we see inventories declining, is it a result of a lot of sales and a hot economy, or the producers are making less? On a month-over-month basis, we see petroleum products down 6.8%. That's the biggest decline in inventories, which kind of makes sense because gas prices have been down. The biggest increase in inventories has been farm product raw materials as well, but it's a little bit more telling on a year-over-year basis. Metals and minerals inventories are down 250%. Now, the metals, in all fairness, is calculated in a little bit of a different way, but nevertheless, with gold at historic highs, it's very logical to assume that it's flying off the shelves. After that, the biggest decline in inventories is represented by farm products on a year-over-year basis, apparel as well. Now, we recently took a look at the Google Trends data as it relates to Black Friday shopping, and what that showed us is that while this year was a little bit better than last year, over the course of the past 5 years, it was actually quite bleak. So, with that in mind, the fact that the inventories on apparel is a very popular item sold during the holiday shopping season, because those inventories are down. Do you think that's the result of a lot of shopping and a lot of consumption, or less production? Because the increase in inventories is machinery, equipment, and supplies, which relates to manufacturing. Just the other day, we were talking about the manufacturing numbers really not looking so hot. Now, we've ranked these charts in order from the highest to the lowest in terms of the increase in inventories or decrease. So, the biggest increase is machinery, equipment, and supplies. Now, that could mean either the producers are making a lot more of machinery, equipment, and supplies, or the consumers, meaning the factories, are buying less. If it's the latter, that's not really a good sign because it shows there's weakness inherently within the manufacturing sector. Motor vehicle parts and supplies is a little bit above 13% on a year-over-year basis, but we can see over time a steady trend to the downside. By the way, the white line's the S&P 500, just to give us a little bit of context in terms of correlation. We don't really see a lot of correlation here. Actually, well, we could say there's a negative correlation, but not a very close one. Here we see durable goods. Now, these are the items that are made to last more than 3 to 5 years: appliances, computers, automobiles. Inventories, the increase is barely in positive territory. It's the lowest number we've seen over time. So, these durable goods, which a lot of them are directly related to the housing market, appliances, washing machines, maybe there's less consumption for these products because there's a risk of a slowdown in the housing market. Beer, wine, and distilled alcoholic beverages inventories actually almost, well, barely in negative territory, a little bit less inventories than this time last year. Lumber and construction material down almost 10% on a year-over-year basis. Certainly a lack of inventory, but if we were to say, is housing slowing down? Well, it can't be consumption then. We're not consuming more lumber and construction materials in a slower housing market, though, so that intuitively tells us that maybe the producers are just making less lumber and construction material in anticipation of an even slower housing markets. Chemicals and allied products down almost 15% on a year-over-year basis. One of the reasons we mention this, we say this a lot, is because we want to take a look at the individual subsectors. So when we go back to our investment portfolios, we can say, well, do I have any stocks? Am I invested in anything that has exposure, like Dow Chemical, for example, may have exposure to the chemicals and allied products? because those inventories are down, we then again have to ask ourselves a question. Are inventories down because these products are flying off the shelves and consumption is up and sales are great? Or the latter, that maybe there's a slowdown in production in anticipation of even slower markets? Petroleum products on a year over year basis down 15%. This is one of the biggest decreases we've seen in actually quite a while. Good news for those of us at the gas pump. Computer equipment and software, which speaks directly to office work. Still a lot of remote work, less than before, but certainly inventories are down. Maybe that also reflects a slowdown in business consumption. Apparel down 20% on a year over year basis. This is next to the lowest low we've seen in actually quite a long time. In all fairness, what we should really do the next time around is take a look at this and overlay this with sales so we can compare sales to inventories. If sales are up and inventories are down, that's a good thing. But I suspect sales are down and inventories are down, which means production must be down, logically. Farm product and raw materials, that's down 25%. It's a better number, or a higher number, I should say, a less of a decrease in inventories, but nevertheless, still marking a negative for the year. And on a year over year basis, we can see the trend overall if we compare these different sectors. So we see the apparel, for example, that's the green line. About August of last year, actually the beginning of the inverted bond market, around June of 22, we saw apparel inventories were quite high. Now that apparel has fallen so much and is now in second to last place, so to speak, uh, we have to ask ourselves again, are the inventories for the apparel sector down because they're flying off the shelves or because production is down? Take a look at the red line. That's machinery and equipment supplies. It has been declining steadily. It's still the highest inventory that we see over here, almost 20% on a year-over-year basis, but even those inventories are starting to decline. In second place, motor vehicle parts and supplies, and that is certainly very interest rate sensitive, to say the least. By the way, the dotted white line in the middle, that's the durable goods. That's the center number for those products that are made to last more than 3 to 5 years. And then in last place, the yellow line, farm product and raw materials, those are actually down quite more significantly, over 40%, going back to around May of this year. The inventories have come up to an extent, but maybe we would expect a decline. Actually, we would expect an increase in the farm product and raw materials as we see a decline in inflationary pressures lately. Food gets cheaper in the supermarkets, and then maybe that translates over to the farm product and raw materials. Then again, there's a lot of moving pieces within the sector, so I don't know if it's fair to make that jump by itself. Nevertheless, the overall trend is slowly to the downside. Some sectors, like apparel, moving faster than others. It would be interesting to compare the stocks in the apparel sector, which by far is probably showing us the biggest decline in inventories compared to, well, machinery, equipment, and supplies, the factory orders, things of that nature. It'll be interesting to see the difference between the two. Certainly worth a discussion. We're going to continue to watch this very carefully because it certainly seems to be a number that has been moving quite readily lately, and we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.